Well, retail sales out this morning. Once again, the consumer keeps spending, rising 0.6% in December. Clothing and accessories posting a big gain during the month, seeing a 1.5% increase. Our next guest saying that the December numbers are not a complete washout, but are not particularly strong, especially on a historical basis. Let's talk about that with Jerry Storch. He's a former CEO of Toys R Us, here to break all of this down. And Jerry, just your first reaction to the fact that consumers are still spending, but it sounds like you're not too excited by the numbers that we got out here this morning.
Well, they certainly came out stronger than I thought they would when I wrote up my notes that you're referencing. Having said that, keep in mind inflation is still 3 to 4%, and so on a year-over-year basis, the retail sales, if you take out restaurants and stuff, we're up about 4.8%. So still a good number, but not as high as it had in past years. It's the weakest number I would say since about 2019. We had huge numbers during the pandemic. There's some clear winners here. I mean, automobile sales were up 10% year over year. That's remarkable. Electronics also up 10%. So maybe some good news for stocks like Best Buy and people like that. Cosmetics continues to be very strong. It was definitely a cosmetics season as consumers are strapped, and e-com continues to roll. The internet. Weak categories were furniture, which are highly related to interest rates. And also department stores continue to be negative year over year, suggesting that they are in for a world of hurt as we go forward.
Okay, so two of those things that we do want to break down here. We were just breaking down some of the home builder sentiment and confidence readings. How much of what we're anticipating in one category that you were mentioning in furniture and some of those home goods, how much of that is tied back to the housing market as well?
A lot of it is the first thing you do when you buy a new house, right? Is you need to get the furniture for it. Another category that was down and has been down for quite some time on a year-over-year basis is building materials. People like Home Depot and Lowe's, and so we've been waiting for that to try to turn around, but it's not happening. And they posted spectacular numbers during the pandemic when people were stuck at home, had nothing to do but fix up their home, and now they've been negative for quite a while.
Jerry, when you talk about who's best positioned within this race, lots of focus on some of those discount retailers, especially when you compare it to the troubles that we've been seeing within department stores. Who, from your view, is best positioned at this point? And do you see that trend at all changing as you look ahead to the next 12, 18, 24 months?
Look, eventually, as I said, these numbers were better than I thought they would, but eventually the consumer has to crack. They're under a lot of pressure. Inflation continues. It may not be as high as it was in the midst of the pandemic, but it's still high by historical standards. A lot of the spending that we're seeing, based on other data, is being fueled by consumers going into debt, both with credit cards and buy now, pay later types of apps, and eventually that comes home to roost. So you have to feel things are continue to slow as we go forward. The most likely winners in that environment are fairly obvious. It's Walmart, who's done well, good times and bad, and Costco, who just keeps doing it. They keep delivering, and I think that's because they really are a great value for the consumer. And someone like TJ Maxx, who undoubtedly has a lot of the apparel increases that you see in the numbers that came out today. So they've been doing very well as we come out of the recession. People need to dress up again.
Jerry, and I know that as your position, as Storch Advisors CEO, but also former Toys R Us, you have also, of course, former Hudson's Bay CEO, and still hold board appointments at, I believe, Bristol Myers Squibb, as well as over at Fanatics. You've got to read and a line of communication into many CEOs that are still out there right now. What is their biggest concern or the red flag that they are watching and monitoring with this consumer right now?
Look, I think most people feel like we're somewhat on borrowed time, and that the numbers certainly have been better than we all thought they should have been. But there are some tough pockets out there, and again, I highlight that department store number. It's not a good number. The luxury space, I've heard, is not doing very well, which is also a sign of a stressed consumer, and particularly that decline or that stress on luxury is coming from what we call the aspirational luxury shopper. They're the people who every once in a while buy a very expensive pair of sneakers or an expensive handbag and save up for it. Not the really wealthy people, but the people just a little below that who are struggling as we go forward here. So I think what we're all going to watch here is to see whether or not the inflation can come down and incomes come up to the point where people are doing better than they were doing. We've had year after year after year of this compounded inflation, and products still look very expensive to consumers. I think people thought maybe inflation would reverse, right? You'd have deflation. You're hearing more and more talk about that, but you're not really seeing it yet, in the numbers when you go shopping, and that's what we need to see for the consumer to be stronger.
Hey, Jerry, let's talk about bankruptcies, because we did see an uptick in 2023 for the year, was up just about 18%, specifically, though, within the retail sector, given the fact that we are in the midst of a turnaround, given the fact that the consumer will likely continue to be under pressure here for 2024. What do you think the bankruptcy picture is going to look like?
Well, the companies to watch are those that are highly leveraged. Retailers, go bankrupt, that's for sure. But if you say who's going bankrupt, it's the ones that are highly leveraged, and they're either leveraged as a consequence of a private equity type takeover of the company. In some cases, companies have been sold more than once from one private equity company to another, or maybe some kind of financing where they tried to generate additional cash through a variety of mechanisms. So if they're not leveraged, retailers almost never go bankrupt, frankly, because the cash flows are so desirable, and you basically don't pay for your inventory until after you sell it, and everyone's okay with that kind of deal, unless they get worried about whether you can pay your debt. So look for the highly leveraged retailers, and that's where you're going to find the ones with the risk of bankruptcy. And there are a number of them on everyone's watch list.
Yeah, and a number of those have been in the department store category, as you were mentioning a moment ago. Jerry, great to have this conversation with you. Thanks so much for putting some additional context around these numbers. Storch Advisor CEO, as well as former Toys R Us CEO and Hudson's Bay CEO, Jerry Storch. Thanks so much.